Just sit back and imagine how difficult it would be for a non-Spanish coach that wants to manage a Spanish club but doesn't know how to speak or understand Spanish. How does he address or communicate with his players or even the coaching staff? Chances of him getting that job is almost impossible. Same analogy applies to the ultimate Japanese candlestick patterns for both beginners and advanced traders, something I love to call the language of the market. In other words, it is the interpretation and representation of price action during a certain period of time. To fully understand the candlestick pattern, aka the language of the market, traders must learn to recognize them while it's printing or developing in an actual live chart, its characteristics, and how to utilize them. When a typical trader is asked to mention the names of candlesticks, this is what you will likely get. And that brings me to the essence of today's video, whereby I will theoretically share with you guys my two most effective candlestick patterns.
What?
Yes, that's correct. Two most effective candlestick patterns, both for the bullish and bearish variations, that has helped me tremendously, and I hope it amplifies your trading game as well. Before we go straight to the point, remember, a building without foundation is going to collapse, and that's why we must start from the anatomy of candlestick. Okay, so in this diagram, present us with two candlesticks. The green candle represents the bullish or buy candlestick, while the red candle represents the bearish or sell candlestick. From the labeling, the both candlesticks share almost the same similarities. They both have highs and they both have lows. They both have real bodies and they both have wicks. What differentiates these two candlesticks are their opening and closing prices. So to illustrate furthermore, let's assume one of these candlesticks represents 1 hour time frame. So what this simply means is the opening price of this bullish candle opened right at the bottom of the real body. The lower wick is how low price got to before buying all the way up. And the upper wick is how high price got to before coming a bit down and closing at the top of the candlestick. Conversely, the bearish candle opened right at the top of the real body. The upper wick is how high price got to before selling all the way down. And the lower wick is how low price got to before going a bit up and closing right at the bottom of the bearish candlestick. Now that we have a proper understanding of what the anatomy of candlestick is all about, let's move on to my two most effective Japanese candlestick patterns. The first one is the morning star or the morning doji star. They both have the same, almost the same functions, but for the sake of this video, I'll be using the morning doji star candlestick pattern. This is a bullish reversal candlestick pattern that consists of three candles. The first is a long bearish candle indicating a downtrend, followed by a doji candle, which signifies an indecision in the market, and a long bullish candle confirming a potential reversal in the market. A close above the initial bearish candlestick will be the confirmation buy. The evening doji star is the bearish variation of the morning doji star, which also consists of three candlesticks. The first is a long bullish candle indicating a strong uptrend move, followed by a doji candle, which signifies an indecision in the market, and a long bearish candle confirming a potential reversal in the market. A close below the initial bullish candle will be a strong confirmation of sell. All right, so in this diagram, this is a visual representation of the morning doji star that I explained earlier, which consists of three candlestick patterns. Yeah, while the drawing by the side is its formation on the lower time frame. So for example, let's say this morning doji star was spotted on the 4-hour time frame. The drawing by the side is what it will look like on the lower time frame, like 15 minutes or 30 minutes time frame. with an impulsive bearish move followed by a doji candle, which brings about this consolidation and an impulsive move to the upside. A break above the bearish candle indicates that character has been changed, or break of structure as the case might be. Hence, the buyers are taking control in the market. But note, for this candlestick pattern to work effectively, it has to be spotted at support levels or area of demand in the market. And here is the bearish variation, the evening doji star, which also consists of three candlestick pattern, and the drawing by the side is its formation on the lower time frame. So for example, let's say the evening doji star was spotted on the 4-hour time frame. The drawing by the side is what it will look like on the 15-minute or 30-minute time frame, with an impulsive move to the upside followed by a doji candle, which brings about this ranging or consolidation, and an impulsive move to the downside. A close below the green candlestick is an indication that there is a potential reversal in the market. Hence, the sellers are about to take control of the market. Note, for this candlestick pattern to work effectively, it has to be spotted at resistance level or area of supply in the market. My second most effective candlestick pattern is the bullish and bearish engulfing candlestick pattern. The bullish engulfing candlestick is a reversal pattern that consists of two candlesticks with a small bearish candle followed by a taller bullish candlestick whose body completely engulfs the previous one. Conversely, the bearish engulfing candlestick is a reversal candlestick pattern that consists of two candles with a small bullish candle followed by a taller bearish candle whose body completely engulfs the previous candlestick. In this diagram presents us with the bullish and bearish engulfing candlestick pattern. As explained earlier, it is the combination of two candlesticks with a smaller candle followed by a taller candlestick. Same concept applies to the bearish candlestick pattern as well, and vice versa. While in this diagram, this is what it will look like in an actual live chart, with consecutive bearish candlestick showing a strong downtrend. The last bearish candle begins to show bearish weakness. The first bullish candle completely engulfing the last bearish candlestick is an indication that the buyers are now in control. The same concept applies to the bearish variation. Note, to confirm the engulfing candlestick pattern is a good buying or selling opportunity, it has to be spotted at either support levels or area of demand in the market, or resistance level or area of supply in the market. These engulfing candlestick patterns provide traders with the strongest signal when appearing at the top or bottom of an uptrend or a downtrend, indicating a buy or sell pressure. In as much as these ultimate Japanese candlestick patterns have elevated my trading game and could do the same for you when applied correctly, do not solely depend on them, as you do need other confluences before making any trading decision. Disclaimer, this is not a financial advice. I hope and believe you have gained value from this video, and do not forget to like, subscribe, share, and leave your comments in the comment section below. Which Japanese candlestick help you make the most money in forex trading? Write it down in the comment section and let's talk about it. Until next time, let's grind, let's grow, let's fly, and let's elevate. Peace.